Hey, everybody, welcome back. And guess what? Home values continue on a specific trend in a positive direction. However, we're starting to see a couple of little metrics that we're starting to have some concerns with. Let's get to it. Okay, so many of you are like, George, what are you talking about? And here's the thing. So we're going to deal with residential only. All right. And when we take a look at it, we take a look at what is happening in real time and only in our area. There's a bit of information out there on the national level, a lot of information talking about February. We're in May, and in fact, there's some information out there that they're talking about in March. So this is real-time information as kind of we bobble through our market and what's going on and what's happening with rates. So if we take a look at this and it says, hey, home price appreciation remains, but some interesting trends are appearing. And what you're seeing here is the FHFA versus the Case-Shiller, showing how kind of they match up. And that is a seasonally normal chart. Now, the one thing that we noticed back in February that they're actually talking about now is that we're seeing a little bit of a deviation between FAFA, the federal, It's a Federal Associated Housing Authority. And so here's the thing. We see Case-Shiller and FAFA. I don't know why I find that hard to always say, but it always is. We are seeing some separation on those two. And as we kind of roll things forward, we're seeing them come together a little bit, but not like we normally do. Now, seasonality comes in when we talk about spring inventory going up. We normally see pended sales come up with it. The question is, do we see one happening higher than the other one that's going to give us pause? And over the last 3 weeks, we've actually seen a significant increase in home inventory that we didn't quite see as much last year, but pended sales are definitely following with it. So let's take a bigger look at, hang on a second here, what is one of the key drivers, and that is mortgage rates. So again, Freddie Mac, Sancator says, hey, mortgage rates again declined this week, and they bubble up and down every day. All right, let's be super clear. Mortgage rates do this every day. And on Wednesday we had good news, with mortgage rates because they came down, but we had some positive news in the economy, and so then people started pulling out of bonds. Bonds went down, mortgage rates went up just a tad, a little bit. Not a whole lot. In fact, we've seen only about just shy of a quarter adjustment all the way through. In fact, as we pop back to this, our 30-year, right, is still lower than where we were at this time last year, which was at about 7.22%. Our average is about 6.81. So when we roll over and we take a look at what is happening with the headlines, it says home price appreciation remains, but an interesting trend emerges, which is what we're talking about today. Mortgage applications contract slightly, but remain above the 2-year average. And again, because we're seeing some volatility in the upper right-hand corner, we bopped up on Friday just a little bit to 6.9 from the 6.81. All right. Rates pull back slightly after stronger economic data. That's what we were just talking about. So I know it seems really funny. When the market's not doing so great, bonds do well because, that's a safety area. And so then when the bonds go up, mortgage rates come down. All right. And so because we got some positive information, so we got some people pulling out of bonds, and we have mortgage rates that went up just a little bit, but not much, just a little bit. And that is without a doubt right now the most sensitive element of buyers right now. However, well-priced homes still going off the market within 7 to 10 days, situation normal. And for those that miss that market, if they adjust quickly, they can still capture and capitalize on premium pricing between 100 and 107% of list price versus starting to hit in the downward trend, looking at 96, 98% of list price. All right. That's if you're on market for 20 days. So if we roll over, we just take a look at what Freddie has to say. Here it is. So we can see that we're down week over week, and we're actually down 0.5 point year over year. And you can see that even though we've been bobbling along on the right-hand side of that chart, you can see we're heading back down into favorable territory there. Now, here's the thing. Are the rates going to continue in a downward trend? I say that they are probably going to get back down closer to about 6.5. When the Feds cut their rate, because remember, the Feds have nothing to do with mortgage rates. When they start cutting their rate, I'm going to say probably July, they may do a quarter rate adjustment. Whoop. I think rates are going to go back up like they have the last 3 times, and then they will start coming back down again. It's just a response. So when we take a look then at what the heck's going on in our market, and we look at this, we're like, okay, market times are up basically 4 days. Time on market, they're up 4 days compared to where they were at last year. This year we had 33. Last year we were at 29. That's pretty nominal. We've had some pretty crazy things happening this year. Change of administration, a lot of volatility. We've got people, with concerns on tariffs, employment. So we've had a little bit of a pullback. Not horrible. We're still seeing a list to sales price, which is basically the same, meaning that it was 99% from when I list to the percentage that I sold. If I listed 100,000, I sell at 99. That's a 99% list to sales price for simple numbers. Okay. With that being said, we're seeing that very same thing today. As far as what we saw last month for the month of April, again, very consistent. And so that's situation normal. When we pop this open, we take a look at our 7-day running average for our market watch. In fact, let's blow that up. Look at that. So for 3 weeks now, which we did not see last year or the year before, not uncommon the year before that, we're seeing more homes coming on market than we're seeing going off. So we had 1,438 come on market. We had 1,181 go off market. Now, that's not a monumental number as far as disparity goes, but understand the number of pended homes for the last year and a half, except for 2 weeks, has always exceeded the number of homes coming on. So we're always drawing that down. Now, you might be saying, George, oh my gosh, does that mean that the market's failing? We're seeing homes coming on and homes not going off? Nah, that's not what I'm saying at all. What I am saying is we're seeing that seasonally normal trend, which is normal. And you're going to see that we're actually only up about 14% year over year, which is not a ton. All right. So when we come back and we take a look at the chart, we also have 628 reduced prices, a little bit higher than what we've seen before. And of course, 134 homes coming on market. Now, that is totally normal. And what we are going to start to see in about 2 weeks is the real estate ghost town. As we hit the real estate trifecta, that's where we have Memorial Day weekend, which is at the end of May. Buyers are out doing fun stuff. They're taking a long weekend. That entire week at the end of May is gone. Mentally, boop, they check out. All right. Then we have the kids getting out of school, whether it's, the grade schools or college, and families adjusting to that. Plus, for those that don't, they're out doing sunny summer stuff. They're camping, they're getting out, they're doing other things, and their mind is just not on real estate. That changes after the 4th of July weekend, the trifecta, and the week following July 4th, the buyers come back in. They want to secure their home for that next season, and we will see an aggressive activity up until about mid-August. So keep that in mind if you're on the market or thinking of going on the market, or if you're a buyer wanting to look for a better deal because other buyers are out doing other things. That would be something to consider. All right. Now, let's take a look at the Northwest MLS here. All right. So year over year, our inventory bumped up quite a bit more than what we saw last year, about 14%. not horrible by any stretch. In fact, funny enough, we're actually less than what we should historically be, because even though right now we're at 12,000, we should be at about 16,000 homes, and we're about 12,200-ish, or roughly about 14%, almost 15% higher. So if I blow this up, you can see right here that our pended is up 5% year over year. Our new on market is up 15%. And of course, our active inventory is up almost 15%. Now, when we take a look at what has been happening, you can see from the bottom chart there that we actually bumped up quite a bit just for the month of April. And a lot of that is because people are seeing that the rates have stabilized. When we're during a lot of fluctuation, only seeing about a quarter rate, and yes, it goes up and down quite a bit, that's actually not crazy swings like the half point, 1 point, point and a half, or 1.5%, 0.5%, 1.5%, 2%. We come down, we're only bobbling about 0.25%, and people are timing that. And so there's a lot of confidence, and they're seeing that, hey, there's more home options out there today than what we've seen before. And in fact, new construction is suffering because of the rise, I should say, in resale inventory, which is super awesome. Now, we take a look at this just for the month of April. Excuse me. We only saw a 13.5% increase in inventory, and just a little under 1,000 homes, about 900 and change. We did see a nice bump in pendants, and we saw a nice bump in the number of homes that actually closed. Situation normal. Okay. We've seen a very steady increase in inventory. Pricing has been going up consistently with it. We're not seeing any downturn in pricing. Yeah, sure. We are seeing some homes that are overpriced that are making their adjustments. They're getting sold and then moving forward. Situation normal. In fact, there was a article that came out, I think it was Redfin. I'll have to go back and take a look. It said, there's a disparity between list prices and what buyers are willing to pay. And not according to this. We're not seeing that big shift. We might be seeing some that are overpriced, but not a ton. And people are making adjustments really quick because they know that time on market means less money in your pocket. All right, just saying. Okay, so if we pop over, we talked about new construction. New construction basically kind of suffering because of all of the new inventory that is coming on market. Now, if you take a look at what we've got here, 2024 on the right-hand side, I kind of put it where it was at. And you can see our inventory is a little bit higher. Sales are off a little bit, but not much. Pendants are actually down. You might be saying, oh my gosh, George, what the heck? And I'm like, it's super simple. I mean, super, super simple. Here's the thing. If you have two different homes, one is maybe not quite in the area that you want, or maybe it's not a really good fit, and it's about 10% higher than a home that has maybe more of what you want and in a better location and about 10% cheaper, most of the time people are gravitating over here. And that's exactly what's happening. And so builders are starting to slow that production down just a little bit. And pendants are still staying the same. Yes, they're still offering incentives. Yes, we are seeing, especially with new plots, some price adjustments. There's a lot of concern. I'm not going to say fear. That's not the word. There's, optimistic. I mean, heck, today, to build a 2,800 square foot house, sticks and bricks only, meaning just a framing package, it is $600 less for that same framing package to build that 2,800 square foot home today than it was 6 months ago. Okay, yeah, we've had tariffs in the play for a while, but remember, some of those tariffs have been sidelined because the other countries have been doing what they need to do to bring down that tariff, and it's going to play a little bit of a role into this. And there are some things that are more, there's some things that are less. Steel is up right now, so that is holding back some of the new starts for steel construction because that's a big number. Anyway, so if we come back and we take a look at this, hey, you know what? They're only up 481 homes year to date. They're off 516 homes. That's on the bottom right. 516 homes off year over year, off as far as pended. And we're 327 homes off from where we should be. May actually blow that up for you. There you go. All right. So when we take a look at this and we see our numbers here, you can see that, hey, these aren't crazy, horrible numbers. Sure, when we're dealing with smaller numbers, any amount of shift, especially with, REOs or bank-owned homes, they look massive and they're not. Okay. So really at the end of the day, our market is still doing very well. We are still one of the top sweet spots across the United States. And in fact, when, we take a look at bank-owned homes, okay? We blow this up for you. You can tell we just don't have hardly any inventory. I mean, that is just a smattering of homes, literally from Marysville, North Marysville, all the way down to Olympia, Tumwater, which is a massive area. Now, you will notice in the center of the screen there, really pretty much on the east side, that's the Bothell, Redmond, Bellevue, Issaquah, Kenmore, there's nothing there, okay? And that's because we just have good values, we have good demographics, not saying the other areas don't, but we are seeing more the blue collar, so we see Tacoma, Lakewood, Spanaway, Graham, and of course when we head up, Granite Falls, like Stevens, Marysville, those are the areas that tend to get a little bit more, I would say a little bit more foreclosures because that's more susceptible to what's going on in a blue collar demographic, whether it's employment, whether it's somebody getting injured or something. It has a few different elements that come into play. And that's why in those core areas, we don't see that as much. Again, one of the reasons we are considered one of the sweet spots across the United States. When we take a look at the actual numbers for foreclosures here, here's the thing. Look at this. Our numbers are super low. Oh, sure, it says, hey, we're up 47.8% on pended and we're up 30.6%. That's just a couple of houses. That's not much at all. When we take a look at overall, we have very few homes. And in fact, to show you what it's been year over year, the yellow chart in the center there, that is in a months of inventory. And you can tell we're way low, even as we're heading into the summer, which many times we will see more foreclosures in the summer. We're not seeing quite that level right now. We're still seeing a lower level, which is not unexpected because our market is still doing well and we're still seeing appreciation. And we saw roughly about a 1 to 1.5% appreciation from the first of the year. We're still predicting a greater than 6% appreciation this year if we keep going at this track and we bring down mortgage rates. If we don't, we'll only see about 4 to 6% if we do not hit into the low sixes for mortgage rates, because the two are tied hand in hand. Now, here's the thing. If you have any questions, put them down below. Remember to smash that subscribe button. Let us know you like it. We normally respond to you within 30 minutes, except for on Sundays. And in the meantime, it's going to be kind of a cooler day. Have a great day, and I will see you on the next video. Take care.